Have you ever opened Zillow late at night, looked at a completely ordinary house, and wondered if everyone around you secretly became rich without telling you? I'm talking about the 3-bedroom house with outdated cabinets, beige carpet, and a backyard barely large enough for a grill. The price? $500,000. And somehow people keep buying them. You look at your paycheck, you look at the house, then you look back at your paycheck, and you start wondering if you've missed something. Maybe everybody else got a massive raise, maybe everybody inherited money, or maybe the entire housing market has lost contact with reality. The uncomfortable truth is that for most people, it's the third option. I'm Alex, and today I want to answer a simple question. Who can actually afford a $500,000 house in 2026? Not who can get approved for one. Not who can barely scrape together the monthly payment. Not who can survive 1 month at a time while praying nothing breaks. I mean, who can truly afford it while still saving money, investing, sleeping well, and enjoying life? Because those are very different things. And once you run the numbers, the answer becomes surprisingly clear. Let's start with the biggest misconception in real estate. Most people assume affordability is determined by the bank. If the bank approves you for a mortgage, the house must be affordable. Right? Not exactly. Banks don't ask whether you'll be stressed. They don't ask whether you'll be able to save for retirement. They don't ask whether you'll panic every time your car makes a strange noise. They simply calculate whether you can probably make the payments. Those are two completely different standards. The bank's goal is to issue loans. Your goal is to build a stable financial life. And those goals don't always align. Let's look at the numbers. A $500,000 house sounds expensive. But in many parts of America today, it's considered normal. Not luxury, not high-end, just normal. In cities like Denver, Austin, Nashville, Phoenix, or countless suburban areas around major metros, $500,000 barely gets you into the market. The problem is that incomes haven't kept up. The typical American household earns around $80,000 to $90,000 per year. Yet homes are often selling for 5 or 6 times that amount. Imagine buying a car that costs 6 years of your salary. You think that sounds ridiculous, but somehow we've accepted it when it comes to housing. Now let's talk about the down payment. The traditional recommendation is 20%. For a $500,000 home, that's $100,000. Just pause for a second and think about that. $100,000. For many households, that's more money than they've ever seen in a savings account. Even if you save aggressively, building that amount takes years, sometimes more than a decade. That's why many buyers put down less, 5%, 10%, maybe even 3%. And while that gets you into the house faster, it also creates another problem: private mortgage insurance, or PMI. This is essentially an extra monthly fee because you didn't put enough money down. What's funny is that the insurance doesn't even protect you, it protects the lender. You're paying extra because the bank is worried about its own risk, so right away, your monthly housing costs increase. Then comes the mortgage itself. Let's say you put 10% down, that's $50,000. Now you're borrowing $450,000. At today's interest rates, your principal and interest payment alone is likely somewhere around $2,800 per month. And that's before we add anything else. Because the mortgage payment isn't the real payment, it's just the beginning. Next comes property taxes, then homeowner's insurance, then maintenance, then utilities, then unexpected repairs. Suddenly that $2,800 payment becomes $4,000 or more. And that's the number most buyers underestimate. Nobody gets excited talking about a future roof replacement. Nobody dreams about replacing a water heater. Nobody imagines spending thousands fixing plumbing issues. But homeownership includes all of those things. A house isn't a product. It's a never-ending subscription service disguised as an asset. Every year something needs attention. Every year something breaks. And eventually something expensive breaks. Now let's look at income. Financial experts often recommend spending no more than about 28% of your gross income on housing. Using that guideline, someone spending roughly $4,000 per month on housing would need an income around $170,000 to $180,000 per year. That's a lot higher than most people expect, and is certainly a lot higher than the median household income. Even if you use more aggressive lending standards, you're still looking at well over $140,000 annually. That's why so many homeowners feel squeezed. They're not necessarily irresponsible. They're simply trying to make numbers work that were never supposed to work. Let's imagine a couple earning a combined $160,000. On paper, they're doing great. Most people would consider them successful. They buy the $500,000 house. Everything seems fine at first. Then reality starts showing up. The grocery bill increases, insurance premiums go up, one car needs repairs, a child needs braces, the HVAC system stops working during the hottest week of the year. Suddenly, every month becomes a balancing act. And here's the part nobody talks about. The stress isn't caused by one giant disaster. It's caused by dozens of small financial pressures stacking on top of each other. You start hesitating before every purchase. You delay vacations. You postpone investing. You stop contributing extra to retirement. You tell yourself things will get easier next year. Then next year arrives and something else breaks. That's what being house poor looks like. From the outside, everything appears successful. Inside, every dollar already has a job. Now, here's something interesting. Many people assume owning an expensive home automatically builds wealth. Sometimes that's true, but not always. Because wealth isn't just about assets, it's also about flexibility. Imagine two families. Family A buys a $500,000 house and spends nearly half of their take-home pay keeping it. Family B rents a modest place, invests aggressively, and keeps substantial cash reserves. 10 years later, which family is wealthier? The answer isn't obvious, because while one family built home equity, the other built financial freedom. The ability to invest consistently often matters more than stretching for the biggest house possible. This is where social pressure enters the conversation. People don't just buy houses because of math. They buy them because of expectations. Their friends are buying, their parents expect them to buy, social media tells them they're falling behind if they don't buy. Eventually, the emotional pressure becomes stronger than the financial logic, and that's dangerous. Because the housing market doesn't care about your feelings. The mortgage payment arrives every month regardless of how motivated or optimistic you are. The numbers don't change just because everyone else is doing it. What's even more frustrating is that previous generations experienced a completely different reality. Decades ago, homes were often 2 or 3 times annual household income. Today, 5 or 6 times income has become common. The rules changed, but the advice didn't. People still repeat old financial wisdom as if nothing happened. Just work harder. Just save more. Just stop buying coffee. As if skipping lattes somehow creates a $100,000 down payment. The truth is much simpler. Housing became dramatically more expensive relative to income, and pretending otherwise doesn't help anyone. So, what should you do if you're looking at homes today? Start by ignoring what the bank says you qualify for. Instead, calculate what allows you to maintain your quality of life. Can you still save? Can you still invest? Can you handle emergencies? Can you survive a temporary job loss? Can you sleep at night? Those questions matter far more than the approval letter. Because the goal isn't owning a house. The goal is building a life. A house is supposed to support that life, not consume it. And for many people, that's the biggest lesson. There is no trophy for buying a house that leaves you stressed every single month. No award for spending every paycheck the moment it arrives. No medal for becoming financially trapped inside a property. The real win is creating options, the ability to handle emergencies, the freedom to change jobs, the confidence that comes from knowing one unexpected expense won't destroy your finances. A $500,000 house might be worth it for some families. But for many others, the smartest financial decision isn't buying the biggest house they can qualify for. It's buying the house they can comfortably afford. Because at the end of the day, financial success isn't measured by the size of your mortgage. It's measured by how much control you have over your life. And that's a number no real estate listing will ever show you.